Ladies and gentlemen of the crypto space, we're live on a Monday, February 13th at about 3 p.m. A little late in the day. I was busy this morning doing some IRL, in real life labor activities, which I much enjoy, and I much enjoy the company and team I work with. So, that being said, this is a very eventful start to a Monday. Especially with the Paxos news. And it's very meaningful because the most important thing we've been talking about, and I'm going to continue to focus on with greater and greater attention, is liquidity conditions. It's all about liquidity, which means it's all about the dollar. And as the years go by, the composition of the primary denomination of the world that'll change, but you know, this is exactly what Brent talks about. It's going to take a decade. It's going to take 20 years. Though all the debt on the planet is dollar denominated, so it just doesn't evaporate overnight. These things take a long, long time to play out, especially with what the U.S. did in 2022. There's going to be more dollar cycles. There's nothing about the structure of the global system that's changing anytime in the immediate future. I don't even see it on the horizon yet. There's no disruption to dollar hegemony yet. So liquidity, and obviously we talk about crypto. That's our primary point of reference because that's really the most meaningful market, I would argue, on the planet from an opportunity standpoint and also from a rational capital allocation standpoint, which is interesting. And I'm giving you my contrarian take. That's really what I do, and it's contrarian, but it's not contrarian to me. It just makes sense. I don't want to invest in companies. I don't want the risk of human beings, and that means basically all equities are off the table. I don't want people making decisions for my capital. I want contracts and software that are immutable and deterministic, which also completely restricts, constrains the potential available investable crypto protocols to basically a handful. And this methodology, this ideology, has served me well. I want software to determine the fate of my capital. I want to align with the lendiness of software. If a piece of software, a piece of technology exists and survives extreme volatility, is more likely to continue to exist into the future. It builds lendiness. And if my capital is attached to things that are building lendiness, productive things that have cash flow, my capital is going to exist into the future, and as those technologies are profitable and grow, my capital is going to follow suit and grow accordingly. So that's why I focus on the crypto space. And to understand the crypto space, really to understand the entire planet, you have to understand liquidity conditions. Because to break it down simply, if you want an asset to appreciate, someone has to buy it. For them to buy it, there needs to be cash. If there's cash, that's what liquidity is. Liquidity is basically assessing how much cash is available to purchase something. And to understand liquidity, you have to go granularly from market to market. We're looking at the crypto space. But look, the crypto space has emerging markets. It's an emerging market of emerging markets because look at the breakdown. Obviously, everyone knows Arbitrum, Optimism have been popular lately. Phantom had some nice attention over the last couple of years. Tron has the second most amount of liquidity in the crypto space. Binance Smart Chain is probably in a difficult situation, especially with Paxos and BUSD complexities. Solana has its complexities, but I still have quite an interest on the platform, on the network. Polygon, big stuff, big stuff. Avalanche as well. This whole list is meaningful. All these emerging markets in an emerging market. So we inspect crypto macro liquidity conditions. It's marginally negative sum game, but if you look at Arbitrum is quite positive sum game with 15% week over week. That's a massive increase in total liquidity, which totally accounts for the significant price appreciation of a variety of the popular assets on the network. Now, all things considered, when I see the entire market all negative sum week over week and a 15% bump in liquidity on Arbitrum, I see risk. What I see is extreme volatility because what goes up comes down because the entire system operates in cycles. These financial markets are an extension of nature. And we've talked about the biological analogies to the way these markets operate with regard to predators and prey, so on and so forth. So when you have a ramp in liquidity, you'll have that's an inflation of circulating supply of currency units. You're going to have a disinflation. Next week there's maybe be 4%. So when you have a disinflation, that's going to take the prices off of the stuff that appreciated. You're going to see prices come down. Everything operates in cycles. Anything that goes up will come down. It's the way things work. So capital gains will be taken, capital, liquidity will flow out of Arbitrum back to Ethereum mainnet, will navigate to optimism. Some will go to Avalanche and Polygon. Avalanche hasn't gotten much attention this year, really. Still a marginally negative sum. Optimism is a little bit down this week. Arbitrum is really getting the full force of liquidity flow. Phantom is pretty much boring for most of 2022. And let's look at Polygon. Polygon still, it has some spikes here and there, but it's mostly boring as well. Tron, obviously, with $37 billion worth of liquidity and a 3.32% ramp. This is home base for Tether. If you look at it, USDT dominance. This is outside of the U.S. This is why the vast majority of people that listen to me, we're a lot in the U.S., probably in aggregate, marginal people. Plenty of people around the world join me. But this is why we don't know much about Tron. This is an outside of the U.S. phenomena, and USDT is predominantly an outside the U.S. Currency unit. And USDT has been hot, especially considering what's going on with BUSD. And USDT has been through the ringer, regulatory scrutiny. But in the end, aside from complexities, business complexities, conceptually, it's a Eurodollar bank. And that is something I've been talking a lot about lately. So the more I understand Eurodollars, the more Tether's like, all right, this has been going on since the 1950s, and they just started doing it in digital form. Everything that I've said of late regarding Eurodollars is what I would say is likely the case for how Tether operates its balance sheet. Redemption is an interesting concept when you're talking about Eurodollars because that's not the point of a Eurodollar bank. The purpose of a Eurodollar bank is to get discounted dollars, converting predominantly U.S. sovereign debt into its dollar form. And that's literally something I've been talking about very recently. Very interesting conversations, and it makes more and more sense to me as it continues to digest in my mind. If you look at Ethereum mainnet, USDC dominance. Arbitrum and Optimism as well are USDC dominant. So I would argue that a good part of Ethereum mainnet, Arbitrum, and Optimism activity are United States centric. Tron is definitely rest of the world centric. Not many people in the United States are engaging in the network. Let's look at BSC. I didn't. BSC's in trouble. Is that not screaming trouble? If you're playing around in BSC, that is not the territory you want to be playing around with. BUSD dominated. Come on, this has risk screaming all over it. In fact, all things considered, Tron probably is the most interesting because I think Tether is a great product. It makes sense conceptually, and it's a big deal what a Eurodollar is, especially considering what I think is going to play out with regard to U.S. Financial policy. Notice I said financial policy, not just monetary policy, but also fiscal policy. So let's talk about what's going on in X crypto liquidity. What's going on in the world? What's going on in the United States? So this was a big open to the week with the dollar pushing up on the monthly. It was above the TWAP, the monthly TWAP on Friday. It fell back below. These two green lines right here represent the 2020 top as well as the 2017 top for the DXY price point. The only thing that it can account for this behavior, this topping behavior, this blow off top, this is dollar shortage, and we're in a new world of dollar shortage for a couple of reasons. The most important reason we're in a new world of dollar shortage is because the only way to cure dollar shortage is to provide dollars to outside of the United States, the rest of the world. How do you export dollars from the United States? You buy shit. We get an item, they get dollars. And as Luke talks about, that's a trade deficit. So as Peter Zeihan talks about, come on, 2020 is peak globalization. How the hell are we going to globalize more? Everyone's reshoring. Everyone's pulling back. There's going to be a shift from China and India to Mexico and Canada for the U.S. I mean, it just makes sense. Why are we now working more with our neighbors? Obviously, there's regional commodities and natural resources that we need from certain parts of the world, but the whole dynamic of the system is changing, along with demographics, as Peter talks about. But the composition of liquidity and the flow of liquidity around the world is changing. And what's most interesting to me when looking at the DXY is if you go from 2008 to now and you talk about the highs, this is the first DXY top since 2008 that was caused by the increasing of rates on U.S. bonds. We know that because bonds have been basically near zero or darn close to zero for the better part of this decade. So that it took a while. It took the better part of 2022 for the rate hikes to eventually put in the euro-dollar discount to take the buy pressure off the DXY and push us back down. So this is a very interesting region. Why? Tomorrow, CPI, domestic liquidity in the United States. As they tighten interest rates, it dries up liquidity in the United States. As they QT, that takes liquidity outside, out of the system in the United States, the artificial component of liquidity. As they QT, that drives up bond yields, drives down bond prices. It's sell pressure. When they increase the Fed funds rate, they're arbitraging the yield on bonds higher to meet rate target expectations. And all of that is like a seesaw. If you decrease domestic liquidity, you're significantly increasing liquidity outside of the rest of the world. This is the first time in at least 10 years that they raised interest rates as fast as they did to cure the excess dollar demand by hiking rates. And that is an interesting phenomenon because that is a different reason for the top occurring. These were domestic U.S. liquidity condition changes that were affected by U.S. government policy, Fed policy, which isn't the government, that caused the dollar top. But this was policy that had a dramatic effect on the rest of the world. This is what Jeff Snyder talks about with regard to the disinflation of circulating eurodollars, which are basically dollar liabilities outside of the U.S. This is the first time since 2008 that the U.S. has meaningfully affected eurodollar composition. The only fathomable reason that the DXY could have gone down is not an increase in dollar exports. How do you increase more dollar exports? Globalization. You buy more stuff. That's historically the way it worked. So the only way that the DXY could have possibly come down is if something was cheaper than dollars on this chart, dollars on the Forex market. There was an alternative that was available at a discount, and lo and behold, there's the alternative that has been around since the 1950s, the eurodollar. Bam! It just makes perfect sense. So if CPI comes in weak tomorrow, Where are we? CPI comes in weak tomorrow. The United States has drained an effective amount of liquidity, and we may be at the point where you have to start to address the coming solvency crisis. The housing market is on the verge of just becoming barren in aggregate, not at the margins. Homes are still selling everywhere, but in aggregate, it starts at the margins, but in aggregate is most meaningful. If home sales are significantly decreasing across the United States, doesn't mean home sales are stopping in the relatively wealthy neighborhoods. It's just in aggregate, and that's meaningful. So meaningfully, the U.S. housing market is in deep shit, which leads us down the road of businesses going under, bankruptcies, layoffs, and obviously we're starting to see that with the unemployment uh, metrics that are streaming to us from tech. So what happens when it's not just tech? What happens when it bleeds over into other sectors of the U.S. economy? And ultimately, this all affects tax receipts. And ultimately, this all comes back to what Luke talks about in solvency, all the way up to the national debt obligation level. But obviously, there's a whole complexity with MBS solvency and even just corporate bonds and even personal loans. Look at the damn composition of U.S. credit. So there's an uptick in auto delinquencies, and I'm sure there's an uptick in credit card delinquencies as well. So we have complexities all over the place, but it's the composition of the liquidity that is most interesting. You can have defaults all over the place, which is capital destructive. It drains liquidity. But what has the U.S. just done? The U.S. has just exported the most amount of dollars it has in the last decade. How? By making a discount on euro dollars versus FX dollars. And it looks like it finally caught up with the dollar demand, at least since the end of October of 2022. Now, tomorrow CPI comes out. If CPI is weak, that implies that U.S. domestic liquidity has drained a fair amount. It has reduced economic activity in the United States a fair amount. Inflationary pressures are finally coming down, which is good. The U.S. Fed might be tempted to start thinking about domestic solvency concerns. A pivot is a scary thought. A pivot really needs the dollar to just start to organically come down. Organically means the world is demanding less dollars because of the nature of energy and the balance of things, and there'll be a period of time where the world is demanding less dollars, and U.S. policy, be it fiscal or monetary for that matter, no longer has to proactively address dollar demand outside of the United States. So the optimistic path forward is the CPI comes down, the Fed holds, the dollar keeps coming down. If the dollar keeps coming down and the Fed is holding, then we could start to get into territory of the Fed starting to lower rates. But guess what? I'm inclined to think, my opinion is the dollar drives the whole system up. I'm pretty sure Brent agrees with that. If the dollar rips to the upside, it's not like the U.S. could all of a sudden start globalizing, start buying a shitload of stuff to export dollars to pick a country that is in significant need of dollars, especially as every country around the world has tightened their respective interest rate policy. And we're not going to want to import from China, even though they're loosening and doing a whole bunch of stimulus. They're kind of doing their own thing over there, and we have all the complexities with China and Russia. So it's not like we're going to increasingly globalize to China. It's not like we're doing anything with Russia. They're cut off from U.S. financials. So we don't have extensive trade deficits historically with European nations. And anyway, they're in a complicated financial situation. So there's no way to get dollars to those nations. There's no way to get dollars to the European continent and good parts of Asia. So what does that mean? How do you get dollars there to prevent another run on the dollar? You can't do it through buying things. That's gone. Peak globalization. Peter Zeihan. So if that is the base case, the worst case is a dollar run, and they're going to have to raise interest rates. Raising interest rates puts solvency concern back on the table in the U.S. So that's where the Fed is. The Fed is battling liquidity conditions outside of the U.S., which manifest in dollar spikes, versus domestic solvency concerns. So, you guys are here because you want to understand crypto up or down, price up or down. To understand up or down, you're talking about liquidity into and out of the crypto space. You're not going to get significantly up until you go to this chart and you see all at 10% week over week. That's when you start to see everything run like it did in 2020. Okay? So right now it's still a PVP, marginally negative sum game. There's going to be a lot of capital gains to be taken on the sub-markets of the crypto space. And they're going to retreat to the chain of guaranteed finality, which is basically mainnet. Or obviously Tron is popular outside of the world. I'd like to see CPI come in weak. I'd like to see interest rates hold. I want to see the dollar come down. I'd like to see things stable. Now that's obviously because of how I position myself in the crypto space. I don't give a shit if there's significant appreciation. I couldn't sell my positions even if I wanted to. Voter escrow considered. So what do I want? I want just churn. People are trading, people are looking for opportunity. It doesn't matter if there's significant appreciation, as long as the volume is there. I just want volume. So that's obviously my subjective perspective on what I would like to see. And obviously we don't talk much about equities markets because I don't really care much about equities markets. All I really care about is supply chains continuing to operate and being able to purchase egg sandwiches. And I do care about CPI because I need teachers to remain comfortable financially. I need supply chains and truck drivers to remain comfortable financially. I need the system to keep working so that I have access to these much desired, I would say, luxuries of modern society. You take it for granted that food is put on the shelves of the supermarket. So in order for that to remain available to you, you want to see CPI come down meaningfully. And then you're going to want to see rates come down meaningfully so these companies have a capacity to refinance their debt and remain solvent and keep their balance sheet actually working so they don't have to, well, then again, they don't have to declare bankruptcy, but then again, bankruptcy, there's still a huge amount of cash in the system. So bankruptcy isn't the worst thing. That's why Fred M2. It's not that bad, bankruptcy. As long as there's a huge amount of liquidity, and look how much liquidity there is. There's a huge amount of liquidity. So what if they keep CPI high and we have a meaningful amount of solvency issues? They declare bankruptcy, U.S. equities goes to shit, capital is destroyed, M2 comes down. What is this, 30-something% higher than 2020? There's a huge amount of cash. So this gives me a little bit of comfortability that even if there's solvency complexities domestically in the U.S., there's still going to be one heck of a system. Because what do you do when a big company goes bankrupt? The debt goes away, someone comes in, buys the functional parts of the company, and keeps the company operating in a much more cash flow positive type of structure. So that is comforting. As the solvency complexity, I see resolutions to, and that is comforting from a consumption standpoint. It should be very discomforting from a U.S. equity investor standpoint. U.S. equities are not in a good spot, but we don't care. But because we don't look to that market for all the reasons we talk about. And this is not a U.S. market. This is not a U.S. market. Crypto is not a U.S. market. It's the most important thing. You are an international capital investor when you're investing in the crypto space. You're deploying capital to an emerging market of emerging markets filled with foreign currencies. that are susceptible to all the volatility of the traditional Forex markets. It's just a different Forex market with a variety of different considerations when you're deploying capital, which is why I posted this morning about venture capital uh, education. Because all of you, everyone that's on the stream right now, 35 people, you're a venture capitalist. Even Curve, even Ethereum and Bitcoin, is not really Ethereum and Bitcoin, that's more of a commodity investor. But when you're deploying to any of these protocols, almost anything you talk to me about, that's VC, venture capital, and you're not early, because the venture capital, the real venture capital, got in much earlier. So that's why it's not easy to deploy capital in the space. Here, look, I've been looking at Grail. Camelot's been hot. There's someone that they were buying down here. You know how many people have a large position down at 300, 250? You telling me they're not capitalizing on a 10x? Wait for the liquidity to flow out of Arbitrum. Wait for a negative 10% week. And you'll see what happens to the price point. There's there's meaningful opportunities for entry in a market that is a micro market. Arbitrum has $1.15 billion worth of liquidity. This is a microscopic market. Capital gains are going to be taken. And now, what's most interesting, what would I look for? If I'm not early venture capital and I'm late venture capital, you got to look at the holders list on Etherscan, and you got to watch for the capital rotation. You got to watch for the liquidity. Obviously, 1.15. If it goes down to a billion, 900 million, things are going to slow down. But that gives you your second opportunity, and because cycles will cycle. So as it comes down, that's when you're looking for bottom, and you're looking for the things that performed well and sustained during a draining of liquidity. And those are the things that are likely going to outperform in the future. So this is a very interesting thing to watch. And this is certainly not a time to allocate. You got to wait for the cycle to cycle. And if it doesn't, it just means it's not something you can invest in. That's the most important lesson that a venture capitalist can learn. If there is no discount, if there's no opportunity for entry, you don't take the position. Just because Grail's going to be $30,000, you don't take the position if it's up 10x. You don't. And if it goes to 30 grand, be happy for someone that bought it. Be grateful that someone had a good opportunity. You only allocate capital if you see the opportunity is present. Why? It was up. It's now down, liquidity drained. What are you waiting for? You're waiting for stabilization, liquidity to stop draining. You take a position, liquidity starts to flow back in, it starts to appreciate. That's the venture capitalist opportunity. You got to wait for the old holders to reap their capital gains, for the top holders list to cycle, for their assets to be sold and to exit the position. And now that is part of the cost basis reset process where a floor is found. And we've talked about this historically with Bitcoin and in almost all assets, the concept of a cost basis reset process. So I'm looking at the chart as we talk. And we are nowhere there. This is not opportunity. This is a time when predators, early investors, are going to extract capital from late investors. But on the other hand, this is something I'm looking at. You just got to find the right opportunity. I don't have a meaningful position on Arbitrum that produces cash flow, so I would like to own a DEX on Arbitrum. And in my experience, solidly forks have not worked out well. And Velo's interesting, but optimism is losing some steam, which could present some opportunity. But the problem is the whole incentive system they have with OP tokens, and I'm not fond of the value of OP tokens. I think they're going to depreciate significantly. What do they do? Unless they come up with something very creative. And I don't allocate capital based on. I hope they come up with something creative. I allocate capital as something that had a premium to something that now has a discount, and then you go from there. That's opportunity. Tapsy's in the house. A lot of moving pieces, damn right. Vasco went up only. Um, Up only would be. See, the problem is if they do QE, that means they're buying. That's gonna juice U.S. domestic liquidity. That would be appreciative of U.S. equities. It would drive liquidity into those markets, um, and that would increase bond prices, which removes the euro dollar discount. QE the world is upside down post 2022. If they start doing QE, that's going to make Eurodollar is more expensive relative to FX, and that's going to put buy pressure, or that's going to allow buy pressure to return to the DXY. And as the dollar gets more expensive, that drains available liquidity for everything else. Because this is all about energy. Um, I know the worst possible scenario. The worst possible scenario is oil going up along with the DXY. Some spikes on the Japanese yen. That's not so good to see. Um, Crude. Well, this is an interesting positioning, especially below the moving average on the daily. Let's go out to the monthly and get a decent perspective. Well, a 10 SMA bearish cross of the TWAP. That's interesting. What you want to see is oil come down, the dollar come down, and then you want to see the policy response of the U.S. Oil comes down, the dollar comes down. If they hold rates steady and they slow down QT, then you'll start to see markets pick up steam. Why? Because of this. Because there's a huge amount of currency in circulation. So everyone wants a pivot where they start reducing rates and doing QE, but you don't realize if there's certain conditions and you start reducing rates and start doing QE, they're going to blow up the global financial system, and you're going to have a giant dollar bull run on the DXY, just a resumption of the dollar bull run, and there goes the liquidity in the entire system. There's only a certain amount of energy. That's going to drive up dollars, and that's going to drive up oil. And as oil is driven up, there goes the dollar price, and there goes because if you want oil and dollars are more expensive, you're going to sell everything you want, and that's exactly what happened in 2020. That's why bonds rallied. They were sold for dollars for oil. So it's all connected. Rising oil drives up dollar, rising dollar drives up oil, rising bonds drives down the dollar. Interestingly, that's a bit contrarian to see that mechanism and how it works. So, a lot of it is waiting to see where the dollar goes, which is inspecting what other countries are doing and how many dollars they need to respect their energy demand, and then waiting for a U.S. policy response. Dollar down, oil down, stable or reducing U.S. rates, and maybe a little bit of QE. If the dollar is down and the oil is down, then we get back to maybe a bit of the traditional mechanic where everyone's looking for the pivot, reduction in rates, and a little bit of QE, and that'll juice artificial U.S. domestic liquidity, and there you go. Off to the races with a little bit of up only. I don't think we're going to see up only like we did in 2020. That was a massive, massive fiscal print. And that fiscal was distributed to the domestic U.S. That's weird because usually fiscal is for purchasing, and purchasing is a huge amount of exports, and that's what cures dollar demand internationally. So that was a very interesting dynamic in 2020 because it was trillions of dollars of fiscal, And then we had a massive dollar run. So that all that fiscal that was done in 2020 didn't get exported from the U.S. And that would have kept the dollar from rallying. Um, and that would have had a very different dynamic play out with risk assets and commodities. One curious view. Hello, Raul. BUSD being classified as a security, but USD is not. Yeah, there's a lot to dig in that regard. Um, you know, I think stablecoins are the biggest offering of the crypto space, and the most meaningful is, at least in the current regime of euro dollars, are CDPs. Is Tether, is Abracadabra, which is a, a domestic crypto euro dollar. How else would you describe it? Is KeyDAO, smaller than Abracadabra, but still meaningful. Um, so these are very interesting products because the world runs on dollar liquidity. And when there's not enough dollars, that's when shit really hits the fan. That's why the DXY is so meaningful. And that's why we're looking at it's 10-year US bonds, but we're looking at JP 10-year. Um, and ultimately, this has an impact on yen. And if the yen is depreciated because they're debasing the crap out of it, there goes the dollar. Yen down, dollar up. So I also look at euro volatility because we've talked about how volatility is contagious and the causality is volatility in the bond market leads to volatility in currency, leads to volatility in risk. Volatility in the bond market induces currency uncertainty because of the euro-dollar component. Currency uncertainty, if you're not possibly able to get the currency units you need, means people are going to start to accumulate currency just in case they can't get the currency they need. And how do you get currency? You sell shit. So volatility in currency leads to volatility in the risk markets because people start to sell stuff for the currency. Ah, it kind of makes sense. Very happy I could break this down, not for you guys, but also for me, because in the end, it's really quite simple when you break it down like this. According to crypto Tweeter, USDC is next. Well, we'll see. There's starting to be a lot of vested interest in the U.S. in stablecoins for a very interesting reason. Big business. So, BlackRock took a big piece of Circle's infrastructure. Well, let's see what regulators do when they go head to head with big money in the U.S. So as much as everyone sees risk, that's really why I structured the portfolio like I did. Let there be volatility. All this shit is going to sort itself out. And what remains is going to be stronger than ever. I want to see the attacks. I want to see crumbling volatility. And then we'll see what remains. And if you pick a couple of winners for the protocols that remain, that's the bet. Not whether something on Arbitrum is pumping or something on Optimism or pick a L2 or Alt L1. That's not necessarily the opportunity. That's predatorial activity. Can you capture some capital from other people? Can you reap some capital gains? Can you be the rabbit that pulls a gazelle out of the field while you know the lions are circling? You know that analogy. That's a good analogy. Sure, those are their micro opportunities, and there's plenty of people that are able to make big multiples and do well for themselves. But is that a sustainable methodology for engaging with risk markets? Are you going to have anxiety? Are you going to be able to sleep at night? And those are the things that I focus on most nowadays. Hey, Dirty Sanchez, it's been a bit. Hope it's all well. Gaffer, hey Cap, thoughts on solidly monolith situation? Yeah, bottom line for me, everything that I saw play out with solidly mainnet is I have no interest in any of that. I will not touch it with a 10-foot pole. I am done with solidly mainnet monolith. whatever that protocol is they forked off, Ramses and whatever the hell they're forking with over on Arbitrum with whatever. I have no interest. Now that's very unfortunate, and I feel for Andre because I think he was on the right path with what he was envisioning. But what a mess! And as much as you know, Alex has done well with Velo, uh, but uh, but it's there's no opportunity. It's the OP value is questionable, therefore a good part of the incentives are questionable with regard to sustainability and longevity. Has had significant price appreciation. It's a high emissions protocol. There's a lot of dilution. It's so I don't see any opportunity. Now, bear in mind, I'm saying that I don't see any opportunity for the way I allocate capital, for the conditions I look for before engaging in venture capital, which has a whole lot of complex decision-making processes. And I'm expressing my opinion for myself. Plenty of people can extract capital gains, and I don't completely discourage that kind of risk-taking activity. Just remember, the predators will take your money. So fine, you could be a rabbit and you could get some capital gains. Good. Proud of you if you do that. But just remember this game is scored in dollars. No one was here to tell me that over the last years. I figured it out maybe the hard way. This game is scored in dollars and denominated in egg sandwiches. So this isn't, are you up in Bitcoin terms or you're up in Ethereum terms? Fuck no! I want to know how many egg sandwiches I could buy on a Friday. Can I take my family out to dinner? Can I pay for my daughter's school? Can I pay my car finance? Can I pay a mortgage? Can I pay for registration on my cars? I don't know. I'm just rambling off shit that I have to do this Friday. And all I know is I got to click a button to get that money to do all those things. um, let's keep it going. When easy money mode, says Eric. I talked about that a little bit. I think we'll have easy money mode eventually, but it's not going to be like 2020. That was wild. I don't see that at any point. They're going to need to resolve the debt ceiling because we're going to need to issue bonds to finance fiscal. And then eyes are really on the dollar. And this is really energy demand. So for that, we look to oil prices. If oil breaks out and the dollar breaks out, and I'm pretty sure the Fed gets it at this point, they're going to have to raise rates to remove the buy side pressure on the dollar and juice the euro dollar discount. So I don't see easy money mode around the corner. What I see probably most is solvency concerns, which introduces a great complexity. We need to see the dollar come down. We need to see oil come down. And then the U.S. is probably in the best position to address domestic solvency concerns. It's a whole cycle. Horrible, horrible. Alessandro, do you really think further dollar appreciation really poses any solvency complexities domestically? It seems the system is built with an infinite debt ceiling anyway. Debt ceiling is a cap on dollars outside of the U.S. Bonds are dollars outside of the U.S. That's it. It's as simple as that. Um, Dollar appreciation, solvency complexities. Well, yes, if the dollar appreciates and finds the TWAP as support on this monthly, that's going to force the Fed to not even consider lowering rates. They might have to raise rates and make bonds more expensive, which makes servicing the debt more expensive, which makes domestic solvency more of a complexity because those remittances from the Fed to the Treasury start to further get out of whack, and it starts to eat into our fiscal budget. And if the economy slows down too much, then you really have a significant reduction in tax receipts, and it gets really complicated. Everything has knock-on effects. One thing causes one thing, that thing affects the first thing, and those two things affect three, four, five other things. The whole system is it's not dominoes. It's like a graph. Everything affects everything. A graph is probably the best explanation for how knock-on effects play out. So one thing moving affects this thing, and this thing affects that thing. So one thing literally affects itself. It's really surreal once you start to see the connection between the way things move. Hope that helps, Alessandro. Kay's in the house. I'm vesting X Grail into Grail. Will take 4 more months till I can sell. You know, I'm interested. I'm looking at it. I see all the appreciation. That's cool. Do I see any opportunity for purchase? Nope, not at all. So, you'll see. You can only assess uh, how well you did in hindsight. Hindsight is everything. And then you go from there. And that gives you experience for choices and decisions you can make into the future. Well, I'm interested, and if it works out for you, I'm rooting for everyone. But I am not remotely interested in taking a position at these prices at all. I wouldn't even consider this for a second. We'll see how GMX is doing. I haven't looked at GMX in a while. All right, 64. Had a heck of a run. Reload daily. Had a heck of a run. It came down a bit. 71.64. Woof. Oh, I wish I got this back at $10, $15. I think I had an opportunity a year ago at this point. But it is what it is. Don't buy something unless it's an opportunity to be had. And you need confluence suggesting it's an opportunity. The right conditions need to be there. That's what it means to be a venture capitalist. Um, Craig, what's your thoughts on Stargate? Stargate, well, unlocks is sell pressure, it's risk, it's an increase in liquidity. So I think Stargate is critical infrastructure. I'm not too concerned. Folks are talking about Stargate versus what Link offers, CIP. You know, I think cross-chain is meaningful. Um, I'm not too interested in it from an allocation standpoint because I really want to engage in the market that has the most liquidity. The most opportunities on Ethereum mainnet. It has the most liquidity. But cross-chain, there's going to be a lot of capital flow from a market of high liquidity to a market of low liquidity because you're going to have much more volatility in the L2s and the Alt L1s. So in this regard, the cross-chain is interesting. I have a Stargate position for quite some time. It's all locked, and I'll continue to lock it. It's one of those positions that I consider just voter escrow, and they're there. Interestingly, Stargate does produce a little bit of revenue, which is nice. Link never caught my fancy. And you see a trend with a lot of protocols getting away from external price oracles and being more of an organic uh, offering an Oracle solution for the positions that the protocol offers, which is interesting. I think there's a lot to come with regard to oracles, and I think they're maybe misused a little bit. Oracles are for external information from the outside world. That's a no-brainer. If you want an oil futures uh, perpetual swap, you need the price point, and that's from the real world. That's a use for an oracle, but you don't need an oracle for the Ethereum price. You get it from the curve pool. So they're misused, I think, in many regards. So I like Stargate. You got to watch the liquidity, you got to watch the unlocks, you got to watch the holders list, and you got to find a good opportunity for entry. Let's take a look. This is on BSC. Does it matter? It doesn't because it's arbitraged very nicely. Let's look at it on Arbitrum. So it's had a nice run over the last couple since January. 35 cents up 100%. It's a nice head and shoulders right there on the daily chart. but it's come down significantly. Obviously, they were doing their liquidity incentives, and they significantly increased the amount of currency units in circulation. I don't know. You know what? I'm happy I have a position, and it'll do what it's going to do. And it's appropriately sized for the portfolio, and I have other parts of the portfolio that are productive. This is not this is a very marginal uh, producer in the portfolio. So you know why I like having positions? I like where I like having positions for like historical positions. I consider this a historical position because I took it maybe when it first came out. I was part of their offering because I don't think about them. What I think about is the cash in the portfolio. You can have positions, but it's the cash in the portfolio that matters because you can only do things with cash. The assets, you really don't want to sell. Why? Because if you're selling them, you're invalidate. It means your narrative for allocating was invalidated. My narrative for allocating to this is not invalidated. Price depreciation does not contribute to just invalidation. Something really significant has to change. Like maybe all of a sudden capital flow across chain is meaningless and everything is just Ethereum mainnet, and that invalidates the narrative for this type of ownership. Um, anyway, complicated to manage a portfolio. It really is. Too much risk with solidly management, erratic actors with absolute control, and the exodus of partner teams tells me all I need to know. I agree. Too much vested interest, and I have absolutely no interest in investing in developers. Um, if I wanted to invest in people, I would invest in equities. And the last thing I want to do is invest in equities. I don't want people. I don't want developers. I want developers that produce immutable smart contracts that are deployed. I want to invest in software, software that cannot change, which is exactly why I like what Andre talks about. He's probably one of the most vocal voices talking about immutable contract deployment. So that's why there's so few protocols really to think about, at least from my framework, with regard to allocating. Says Eric, what happens if nations start paying for their energy in a currency other than dollars? I don't know. We'll check back in 10, 15, 20 years. Everything in macro financials takes 5, 10, 15, 20 years to even start to see the dynamic change. They're already starting to denominate energy in different currencies. The problem is um, if all of a sudden a good part of the oil market is not dollar denominated, what does that do to the dollar? All of a sudden, there's a huge amount of dollar liquidity available. Totally changes the entire liquidity flow dynamic. It doesn't it doesn't change dollar hegemony at all. It just means now people are going to have money to buy other shit with. So it changes the whole flow of the system, and I would argue that that's occurring. Peak globalization in 2020, the whole nature of the system is changing. Folks are starting to want to denominate energy in other currency units, but it's not so simple. Why? Because people want to buy energy in dollars. They want to. That's why it occurred in the first place. And now that the U.S. has flooded the rest of the world with relatively cheap euro dollars, with the 2022 fastest rate hike cycle in history, now there's excess dollars. Oh, I want to buy in with using dollars. It's a lot of dollars. So it's not so simple. Nickman, my man, you've described the things we need for bullishness. We don't have all those things yet, so I'm thinking of nibbling the macro coins. Is this week's dip a discount in your opinion? Well, eyes on the dollar. Last month we had a breach to the downside of the TWAP. I would wait 2 weeks from a comfort perspective. You want to wait for a close of the DXY below the monthly TWAP. You want to see a lower low, which would be like, the breakout, the retest, and the higher high. So this is the breakout, the retest of the TWAP, and then you want the higher high. If you see like the 101 below 102, and you start to see the push down towards the 50 SMA on the monthly, 97, you're going to have a heck of a risk market rally if you start to see a continuation down to 97. And this is the monthly. This takes time to play out. This takes months to play out, a push down to 97. And you don't want the volatility. The volatility starts every market around the world puts it into convulsions. Albeit volatility to the upside could be interesting, but the higher high, which would be a lower low in this context, lower than 102, and you're going to start to see a positive reaction to risk markets. And in order to see this, you're going to see, look at bond vol picking up. Bond vol leads to currency vol, but bear in mind volatility goes in both directions. So, you know, when volatility strikes, you got to be on edge. What's it going to do? Something's happening. This is basically shit's about to go down. Eyes on. Where's it going to go? Up or down? Bond vol, currency vol, risk vol. But bear in mind, look at the pop of bond volatility. Then you look at the 10-year and you see that it's up. Bond yield's up means there's a cheaper euro dollar discount, which is going to take the buy side pressure off the dollar, which is depreciative. Cheaper dollars means there's more dollars to buy energy, and there's excess dollars, so they're going to be buying risk. So it's interesting to see bond vol up and dollar down. And that's because bond yields are up and bond price point is down with the cheaper euro dollar discount. So this is why there's a tailwind on risk assets, because of these components moving the way they do. It's like gears in a machine, and these gears are spinning right now in the right direction. A supportive direction, a tailwind direction rather than a headwind direction. If you saw bond vol up and 10-year yield starting to come down, and DXY popping a bit, poking its head out above the DXY, you're going to see risk market volatility, probably a pop in the DXY to the downside on price points. Hope that helps. Crypto Monger, have you played around at all with providing liquidity in Uniswap v3? Yes, and I will probably never do it again. Recently got into SYN Ethereum, 0.3%. The fees yesterday were bananas. Annualized APR was 1,700%. It's interesting, but I'm not interested in ever providing liquidity ever again to Uniswap v3. I'm much more interested in the future of providing liquidity because I really think the entire crypto space is in desperate need of better opportunities for smaller portfolios and less experienced portfolios, which I would argue is probably providing liquidity. Gamma Swap is very, very interesting. I'm looking forward to what they're offering from a consumption standpoint and also from an opportunity standpoint for persons that don't have the experience doing venture capital and inspecting Etherscan for the holders list, inspecting liquidity, unlocks, the stuff that we look at, all the volatility and the macro stuff. So I really think a new and improved way to provide liquidity is a great opportunity for newer participants in the crypto space. And I very much look forward to what Gamma Swap is building. Wish I was able to take a piece of their seed round, but it is what it is. It's okay. As a product, I'm interested. Very interesting. Mickmon, very helpful answer. How does high bond yield mean cheaper dollars if it's got to take years for the yield to be paid out? No, it doesn't work like that. And bond as an investment is an entire other calculation. That whole real rate bullshit, it's marginally outperforming inflation. And if you take into account the amount of price increase over the years, bonds are a silly investment. Historically, every permable on bonds, they're not looking for yields. They're looking for price appreciation of the bonds, because if you look at the 10-year, it's just been price up for the last 40 years on bonds up until 2020, which is the blow off top. I mean, come on. If you invert this, that's a blow off top on bond prices, if I've ever seen one, to the point where it broke the structural trend to the downside. Absolutely fascinating. So, there's a couple of tweets I put out, Mickman, about how the rapid rate hikes made a discount on bond prices such that you could make dollars out of bonds cheaper than you could buy the dollars on forex markets. And this really requires an understanding of the global money system and what money is. Most of you don't use dollars. If you have a physical dollar, a paper dollar, you're using dollars. But if you're paying a credit card from a bank account, you didn't use dollars. You used dollar liabilities. You used the claim on dollar bills that have been rehypothecated 10,000 times over. For example, this isn't dollars. There's 21 trillion synthetic dollars in the system, but if you go over to base money, these are the amount of dollar bills in the system. There's only $5 trillion bills in the system. Now there's $21 trillion that have been made, printed by the commercial banking system based on these $5.4 trillion issued by the United States Treasury. Now, the U.S. has $31 trillion worth of debt. The rest of the world outside the United States takes those bonds and deposits them in what can be labeled a euro dollar bank, and that bank gives them a bank account. If you buy $1 million worth of 10-year bonds, you could give them to this bank, and the bank will give you a bank account with dollar deposits. You log into chase.com, it says $1 million. You log into eurodollarbank.com, you give them the $1 million worth of bonds, and they give you $950,000 deposit in a bank account. And that's what bonds are to the rest of the world. And there's obviously bond investors, but that's a whole other story. We're talking about dollars and euro dollars. This is Jeff Snyder land that I'm trying to explain in Noah terms. So this is very much Captain Rational's Eurodollar University, because I have recently had some good understanding of how that mechanism works. And why is it likely the case that I'm pretty much right? Explains everything that has happened. And we have the Eurodollar system, so clearly the rest of the world is using collateral to print dollars. So what is the mechanism for them to do that? It's what we've been discussing. Hope that helps. Asarko, my man, always a pleasure. 37 people in the stream, 15 likes. Come on, we could do a little bit better. Smash those like buttons. I appreciate the support, everyone. Let's wrap it up for today. I wish you all a good one. Be safe. No, not much else to look at. Eyes on liquidity. Watch for some inflows. Be careful on Arbitrum. And we're all eyes on the CPI tomorrow. They'll be interesting. So be safe. Tell everyone to subscribe, because if you don't listen, I can't help you guys take a little bit less risk and do a little bit better. Monday, February 13th at 3:57 p.m. I will see you guys on Friday after party on Discord for the most rational community in the entire crypto space. See you on Friday. Peace.